The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Welcome to Winning in Retirement. I'm Brian Akers, president and founder of Akers Financial Group, and I'm hosting this Winning in Retirement radio podcast. So thank you very much for tuning in. Today we have a very special guest from Brookstone Capital Management in Wheaton, Illinois, Mark DiOrio. Mark DiOrio, good morning.
Good morning, Brian. Happy to be here.
Yeah, it's great to have you here, Mark. Mark DiOrio is the Chief Investment Officer of Brookstone Capital Management, Akers Financial Group. When we manage money actively, we go through Brookstone Capital Management as our third-party money manager, and we have money managed by Brookstone, led by Mark DiOrio, and also we have joint portfolios where Mark and Akers Financial manage together, and we call those AFG Select portfolios. So today we're going to talk about Mark. Mark, so you're a big-time Chicago fan?
I am. Sometimes it can be challenging.
Are you a White Sox fan?
I have historically been an American League guy.
American League guy.
And that would lead me to the White Sox. But I would say that the Cubs are very popular in Chicago.
Yeah, extremely popular. But the White Sox are having a good season.
They are. They're at the top of the bracket.
Yeah, that's an unusual place for them, I believe.
It was highly unexpected.
Yeah, so we're talking about the markets. We're talking about the mid-year review. I know over the years we've been working together, managing money for our clients. And I just want to try to get a little introduction to the people. So you been doing this for more than 20 years?
I have more than 25 years.
No way.
Brian.
25. Wow. Well, I've got 35 plus on it.
Yeah. So we've been around. We've seen a few events in the marketplace for sure. And I think part of that actually defines a lot of my career going through crisis events.
Yeah.
So if you look at bookmarking my career, I'd say, well, crisis events have definitely been part of those, and how you manage through those and get through those,
right.
Kind of unscathed. Obviously, everyone feels the dips and price declines, but can you get through to the other side and then benefit from the long-term performance that the asset markets provide? So going through those have definitely shaped my career.
And that's why when you build out the portfolios that we get to choose from at Brookstone, you have a lot of choices, and some of them, or most of them, have different ways of providing diversification from in the market. You have different portfolios that provide alternatives completely to the market, and some are even buffering the market. So can you just give us a little overview of the styles of management that you have at Brookstone?
Well, you made a good point about a wide selection of choices. So we run on what's called an open architecture approach. So we have a number of mutual funds, ETFs, individually managed portfolios with individual securities, and then active management on top of that. And so it's not just an open architecture, meaning we would use kind of best of breed in any category. What's the best bond allocation? What's the best stock allocation? Growth stock, value stock, and so forth. But we want to make sure we have enough choices as markets go in and out of kind of favor and trends. We want to make sure we have investments that have already performed due diligence on, that we can incorporate into a total portfolio. And so what we're really based on when you look at our investment philosophy is based on a core asset allocation consistent with your risk profile. And then we bolt on a satellite allocation. So it's called a core plus satellite allocation approach. So with that satellite, maybe there are times when you feel a little bit more aggressive, and you can take with a portion of the portfolio, again, that would be risk appropriate given an individual situation. You could get more aggressive, maybe go further into tech. A lot of investors that we work with, Brian, as you know, like income. And so they may want to boost up their asset allocation with more income generation. And that could be in dividend stocks, that could be in other asset classes that they may not have thought of, that we have access to and that we've researched, and just being in the business, and we can feel comfortable incorporating into an investor's portfolio.
Yeah, and I know in the last few years you've actually created the Brookstone Asset Management and the actual ETFs. How's that going?
We did. So we created Brookstone Asset Management as just kind of an offshoot to augment our asset management selection. And we actually partnered with key kind of team that performs what's called smart indexing. Basically, they are kind of an index shop. So like the S&P 500 is an index. Mm-hmm. Well, this shop just doesn't do it based on market cap, or the largest companies have the largest allocation in the index. What they do is perform fundamental and quantitative analysis on the stocks and create a very unique stock basket in growth, value, dividends. So we partnered with them, and we think it's a real key strategic relationship. So that's part of our role, actually reviewing other managers and what they can bring to bear on portfolios. So incorporating them has really been a unique story for us. In fact, the firm that we use runs the Barron's 400 and has for 20 years, but it's still kind of a boutique name behind the scenes that is not well known.
Yeah, and I know with all this going on, you and your team have done a great job of working with our clients and managing over the years. Now, Mark, there's a lot of things going on in the market. Makes everyone want to think short term, but I always try to get them to focus long term. But with the halfway through the 2026 year, do you mind giving us a little bit of what your thoughts are on oil, inflation, and where we stand with all that's going on?
Yeah, definitely. And you mentioned the long term. I'll just start there and then back into those questions of the events of the day. But yeah, the long-term benefits of the market, people sometimes get confused of why stocks go higher over time. Well, it's because earnings rise over time. And so distributable cash flow to equity stock investors grows over time. So think of those companies that have been around for a long period of time. Well, they continue to grow, and that ultimately benefits the shareholders. And so earnings growth has a real consistent path in the U.S. Of growing at 6-7% real, meaning after inflation. And so and you add in maybe 3% inflation, and you get to that 10% type long-term returns on the equity market. But it's really the earnings growth that these companies do. So that's the long-term and kind of the fundamental reason to be an investor, where the benefits kind of come from. The issues of the day, you hit on them. Oil. We've been monitoring oil. Of course, there's the spike earlier this year on the Iranian conflict. Well, those prices have now come down. So we went over $100 a barrel. They're now settling in that $70 to $80 a barrel range. Of course, it continues to be an ongoing risk, but prices have come down. The market is concerned about inflation. That's the general rise in prices. Mm-hmm. And so what inflation does is, well, and on top of making everything a little bit more expensive, the Federal Reserve would then raise interest rates to try to slow down demand, which would slow down inflation. And that's kind of the general playbook. And so the market's now a little bit unsure of what the Fed will do. Will they raise interest rates? And so the market actually expects them to raise interest rates. I would say our take would be, I think the Fed does not want to raise interest rates from here, and so this is a short-term issue, and that if oil prices come down, inflation should kind of normalize and stay rather muted, and so that'll be a key component. And then going into looking at how does that impact earnings? Well, since we started with the long-term growth in earnings, here we have earnings which have been very strong for stocks overall. And that's why stocks don't look very expensive, is because earnings have been so strong. So it's really been an earnings story in the U.S.
Wow.
That's really propelled stocks.
Yeah, I guess some of the things you said about the oil's come back into the mid-70s, but where was it prior to the war in Iran?
So it was in the low 70s. So we almost pretty much made a round trip. Oh, wow. And that's not too dissimilar to what we saw 4 years ago when Russia invaded Ukraine, where you had the spike up, but then it just continued to fade. It didn't go into this real fear. So the oil issue is not an oil supply per se issue. We're not running out of oil. It's a transportation issue with the Strait of Hormuz being closed, which transports about 20% of global oil consumption, but mostly to the Asia Pacific region and China. The U.S. doesn't get any oil out of that comes from the Strait of Hormuz. So it's a lot different world in terms of the oil economic impact on the U.S., where we've kind of been able to mitigate it for the most part. We're more tech-driven, services-driven, just a different economy than it was a couple of decades ago.
Yeah, but it all does affect, and it all seems that the price of oil, the price of gas makes us all happy or sad. It makes us all kinds of things when it comes to the confidence level in America.
Yeah, definitely. It's a key kind of indicator of and expectations for prices, and nobody likes higher prices at the pump. But on a slight margin, the U.S. today is a net exporter of oil.
Okay.
And so from the economy as a whole, we actually slightly benefit from higher oil prices. Now, that wouldn't be the standard kind of playbook. The idea isn't higher oil prices, but It's just not the detriment that it once was.
Yeah, it makes sense because oil, it does affect everything we buy, right? Because most components have somewhere you're delivering with oil, gasoline in the vehicles, or you're using oil to produce it. So there's a lot of byproducts there. So the idea of the earnings, you're saying the earnings are great, and that's really helped a lot. So earnings will definitely be a topic later in the show. We're going to cover that in a little more detail, how it's spreading across the markets, small and medium. Well, you have a lot of things when we talk about the Fed. We have a whole quarter on that, on the Fed and the stock market. There's a lot to go over. So generally, just a couple word answer here, Mark. Generally, the first 6 months of 2026, what's your thoughts on the past of those 6 months? Good, bad, indifferent?
Remarkably resilient.
Okay. Oh, so those are good words. Remarkably resilient. I like that because I'm sort of a person that thinks that I don't know why it keeps rising besides earnings. I don't really understand at times. Wow. All right. Well, so Mark DiOrio from Brookstone Capital Management, Chief Investment Officer there. He's been working with portfolios for Acres Financial and our clients for many years. And we do welcome them to our show. We finished that first quarter. And as we finish this quarter, I just want to remind everyone about Acres Financial Group. We're local. We're independent. We don't report to a big company on Wall Street. We report to you. We do have offices in Forest Hill, Lutherville, clients all around the Mid-Atlantic region, and even a few around the world. It's so easy to begin winning in retirement. You just give us a call and schedule your free meeting with one of our team of advisors. You call 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person meeting. Go to acresfinancialgroup.com. That's AKERS financialgroup.com, or call us at 833-946-7384. Do you follow the Fed? Does the stock market? We will talk about this when we return.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers, President and Founder of Akers Financial Group, also a certified financial planner practitioner, financial advisor, and co-host of the radio show here. In the radio show, we have a special guest, Mark DiOrio. Mark DiOrio is from Brookstone Capital Management. In the first quarter, we began our discussion on Brookstone and what they do for Acres Financial Group and our clients in managing money, and also started talking about the market, the oil, inflation, interest rates, earnings. And we just got started. So, Mark, you ready to go here in the second quarter?
Let's do it.
All right. I appreciate that very much. So you're in Wheaton, Illinois, where Brookstone's based on. Brookstone Capital Management manages $14 billion right now?
We do.
That's incredible, man.
Well, thank you. Yeah, it's been a great partnership, and I know that Acres Financial Group is a big part of that and has grown substantially since we started working together.
Yeah, growing together, and our clients are growing together with all of us. It's been a really good win-win for everyone as we've tried to develop and take care of our clients and provide for them and their families for years and years to come. All right, so we got a lot to talk about, Mark. So I know with the 2026 mid-year market review is our show today. My question leading into this is, for everybody listening, is do you follow the Fed? And then the question is, does the stock market follow the Fed? What's your thoughts on that? What do you think about people and the stock market? Who follows the Fed?
Well, historically, a lot of economists would follow the Fed. In fact, there's one great researcher that has written work on this and says, following the Fed for fun and money. So the implication is that definitely very important. And what does the Fed do? So the Federal Reserve, through the Federal Open Market Committee, led by a chairman, and Jerome Powell was the chairman, and now it's Warsh. So we have a new Fed chairman. He'll do interviews occasionally. And this really started back in the Alan Greenspan era, where CNBC and other programs would highlight his briefcase, suggesting where are interest rates going to go. And so the Federal Reserve, what their job is they have a dual mandate, which is to pursue policies that promote stable prices. So think of that as a rule of thumb, a 2% inflation rate. And then also to have policies that promote full employment, which as a rule of thumb is an unemployment rate below 5%. So if you have an unemployment rate above 5%, it would suggest, just a straightforward playbook, that you lower interest rates to increase to help the economy get going, kind of give it a little nudge to get going and get employment back on track. If inflation is the issue and it's rising well above that 2% level, well, you need to raise interest rates and slow down the economy. So that's the general kind of idea behind what the Fed is doing. Why are they raising or lowering prices? So in 2022, when inflation started to become the problem after COVID and the pandemic, and you had very low interest rates, well, they raised interest rates a number of times. And that can be very challenging for the markets, because that's what's called tightening monetary policy. Interest rates rising. So now we're in an environment where interest rates have been lowering recently from those elevated levels, and we're at a sticking point of which direction we go. But get to also answer the point, which was, do you watch the Fed? Absolutely. So if they start to raise, going a tightening cycle, usually the market does fall into challenges, and 2022 would be an example of that. And for those that may not remember, we had a declining market in our bear market in 2022, up until the point where they basically slowed down rate increases. On the flip side, if they start to reduce rates, you're closer to the bottom, and maybe the stocks don't bottom immediately, but that's usually been very stimulative for the market. So so absolutely, the interest rate environment and Fed policy is an input into decision making.
And so what if they only just raise it once or twice? Is that really a factor in the long-term market?
Well, that's a great question. We actually looked at this, and that would be considered a non-cycle, which would mean it's not a tightening cycle where they'd be raising interest rates, trying to choke off inflation, or decreasing interest rates where they're trying to stoke the economy. That would be really a recalibration where they're just trying to find what the right interest rate is, because you never really know, but you're just trying to balance the risks, kind of maintain stable prices and maintain full employment. And you don't want to err one way or the other. You'd rather be at kind of what they call a neutral rate that kind of balances those risks. So so if you have just a one or two kind of move, it's just recalibrating, and then that does not really change. That is not necessarily a signal to the market.
Does the market itself, like a 2-year treasury, 5 or 10-year treasury, sort of give us a peep into the decision making?
So one of the kind of market-based indicators that we use and the market uses is looking at the 2-year treasury. So this is 2-year government bonds issued by the U.S. government. And what is that rate? What is that kind of trading at? And so if that rate goes higher, it would suggest that the expected Fed funds rate is higher. In other words, the market says that the Fed funds rate, what their decision is based off of or where it goes, is actually indicated by the 2-year treasury yield. So it can lead, and there's a little bit of a lag time. And currently, the 2-year treasury has actually risen above the current Fed funds rate. Mm-hmm. And it's indicating that possibly a quarter to 2 quarters, that would be 0.5%, move would be suggested, move higher in interest rates. So that's not a foregone conclusion. It can move around within a band, but it moved up there, suggesting that, well, the Fed may have to raise rates because of the inflation numbers came in higher. And a lot of that was due to oil. So if you break down the inflation numbers, it was the energy prices that rose, as we'd expect, given the rally in oil. But if that's coming down, as we've talked about in the first quarter, that inflation number should come down, and maybe the Fed is close to neutral. So I think they're going to try to hold hold off on making a movement as long as possible here.
So if they made a movement, when's their next meeting?
So it's the end of July and then September. So really it's coalescing around September being that big decision. And of course, we also have the election to contemplate too. And this is a mid-year election cycle. And really we haven't heard too much, and it really hasn't affected the market at all. Historically, you do see the market kind of pause to see what direction kind of the election's going to take. And not that the elections actually have that big of impact on the market from a long-term perspective. It's just over those shorter term, several months, what's policy going to be, what direction are things going to go. And so the market kind of pauses historically during that time period.
All right. I know everybody's listening. They want this one question answered, but you don't have to answer this. All right. So you're basically saying interest rates could go up. So let's say you're applying for a mortgage or refinance. Do you lock in today, or do you try to wait for it to come down a little bit? Or by locking in, then you're taking the lower side of the thing. It might actually go up on you. What's your just general economic thought?
So I would look at the 10-year Treasury, which is a good indicator. Sure. And the 10-year Treasury has been trading around 4.5% for the last 4 years. And I would expect that, plus or minus with some, but I would expect that to continue in that range. So that's not that big a spread from, for example, the 2-year Treasury trades around 4%, for the 10-year at 4.5%. It's not that big of a spread. So I think you can have that expectation that rates will probably be around this level unless you get some type of policy incentives at some point. But that's where I expect. I don't think it's an environment, at least that's what the data shows currently, where the 10-year Treasury has gotten spooked and rates have risen, which would suggest housing market rates, mortgages would rise as well.
So you don't see that, but you would use the 10-year Treasury as your guide in following the rate to make a decision. You would also say that there's not anything there that is actually going to drive it lower or higher at a significant level in what we see currently. That's fair?
Correct.
All right,
yeah,
cool.
Very fair.
How about that? Now, that's winning in retirement. Is though some people have mortgages. Sometimes they might be downsizing and getting a new mortgage, going out of their 2.5% mortgage to the new ones. And it's a little scary having a mortgage in retirement where your rate just doubled on you. And then the whole idea of locking in or not. So I've had these situations with people downsizing. And so I like to be able to ask you some hard questions like that. All right. So this quarter, we've been talking about the Fed and the stock market. And the stock market, what Mark said and what I heard was the market could actually pause some and think about what's going on in the fall here. So as we're investing, we do need to invest. I like buying for the long term. If you need money, I believe the market's is a really good value to sell and to build your cash positions up so that you're ready for the next 12 months. I don't like to leave any money that you need in the market because I think it's a really good time to take the profits, take some winning off the table. Any thoughts on my comments I just made, Mark?
Well, I think you do a good job articulating the challenges of an individual. Where I and the investment team talk about macro issues. Right. Well, you have to distill that into the individual and the individual situation, and then how do you operate and interact with the market? One, being appropriate with your portfolio, and then two, the practical questions of the day-to-day practical issues. So I think it was well said.
I guess I have to send you like a little small gift after that. The hardest part I've found in my career is that being a financial planner is understanding the client needs, the market, and all the choices out there, and then bringing them together one client at a time. And that's where all the effort, all the time has to be when it comes to Acres Financial Group and all of our advisors. Is really, truly listening to the client, listening to everything that's out there, having core people that can help us build these portfolios, and then managing into their decisions that apply to their life. All right, so will this year be the year you finally have a plan to achieve financial freedom? Financial freedom can be achieved when you have a proper plan for retirement. A plan that is as unique as your fingerprint. We have helped hundreds of families in Maryland plan for retirement. Our goal is for you to have a plan that will allow you to have true financial freedom. We design that plan with you, monitor and adjust as needed. We are local. We don't report to a big company on Wall Street. We report to you, our client. Make this year the year you begin to achieve financial freedom by giving us a call at 833-WIN-RETIRE and schedule an in-person meeting with one of our team of advisors. That's 833-WIN-RETIRE, 833-946-7384, or visit our website at acresfinancialgroup.com. Scroll down to the bottom of our homepage, request a meeting right there. That's 833-WIN-RETIRE, or go to akersfinancialgroup.com. What is going on in AI and Mag 7 investing? We'll review this with Mark DiOrio when we return in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome to Winning in Retirement. I'm Brian Akers. I'm here with me today is Mark DiOrio. He's the Chief Investment Officer of Brookstone Capital Management. We work with Brookstone Capital Management at Akers Financial Group to help manage our portfolios for actively trading for our clients. Mark DiOrio, are you ready for the second half here with us at Winning in Retirement?
Well, definitely. We have to turn it up a notch now.
Yeah, second half, you got to come out of the locker room ready to play. We're not going to wait till like the 90th minute of a World Cup game to finally score. There's lots of great World Cup games out there. But the thing that I find is it's amazing how the drama of the ending of a game. But the second half, there is a new intensity. So I hope you're ready for the second half of this show, Mark, because we're going to go intense. We're going with the big one. The big one is this. What is going on with AI and Mag 7 stock investing? What's your thoughts on those pieces of things that we can invest in?
Okay. Well, that's a big topic and is a big theme. So AI is artificial intelligence. And some of those models that you may have run into are called ChatGPT, Gemini, Claude. That's Google's. Claude is Anthropic, XAI. So there's a number of these models out there, and they're built on what's called large language models earlier. So this is where you may ask it a question and it comes back, as opposed to giving links from Google. You know, if you're searching for something online here, it might give you a full paragraph response in kind of normal language or give answers. And so this is what it takes. And it's kind of this next evolution in terms of the advancement in technology. What it takes are three main things, which are data centers, semiconductors, and energy. So those are the three components when you're building out what's needed for artificial intelligence. And so there's been a lot of CapEx or capital expenditures or investments by the Mag 7 stocks. So those are think of the largest 7 tech stocks. So really the massive companies, Microsoft and Amazon and Tesla and so forth, and Google. Well, they've been putting hundreds of billions of dollars in building out the infrastructure necessary. And so that has been filtering through the economy slowly, but they've been seen as kind of the tip of the spear or kind of the leaders of this. And that drove the market in 2025, and they were kind of darlings late 2024. They did a good job as well in terms of, the market seeing what they had, so in relative sense. So those are the only ones with the pockets deep enough to build this out, spend what's needed. So the first component was semiconductors, I should say. Semiconductors are those chips that we all know, Silicon Valley, silicon wafer, the chips inside computers, mobile devices. They're pretty much everywhere. They're in your coffee maker. There's in an average car, there's 1,500 semiconductors. So those are, if rain hits your windshield, the wiper goes off. Well, that's a semiconductor that's said to do it. And so what they do is they process and store data. The difference with AI is you have to do it at a very elevated level and process and store massive amounts of data. And so one of the big winners, early winners, were a couple of these semiconductors companies that had the most advanced chips because they were in massive demand, and all of a sudden there wasn't enough of them. They couldn't keep up with the demand. And the AI spending really happened within these last 3 years. So it's really been condensed. But it's expected to go on for another several years with money continuing and the dollars keep driving higher and higher what the expected CapEx is. So there's a lot of money going into the economy behind this. Data centers is the second thing, and anywhere you go, you can look up any state, where are they building data centers? And I'm not talking about kind of just a normal, maybe storage facility or data center. An AI data center, can be hundreds of acres big. It's massive. And they put in these big machines to run the semiconductors, run the kind of the processing units in these data centers. And to give you an idea, a regular data center versus an AI data center uses the AI data center uses like 50 times or 5 times the amount of copper. And so it's a massive amount that goes in there. So it's a much different at scale kind of operation. And you may see at this phase some pushback where everyone starts to see, data centers being built in their communities, and they come in and the data center needs about the amount of electricity to run as the city generates currently. So depending on the community that it goes into, that has been one of the challenges. Wow. And it's not necessarily a negative thing. It's just one of those, you build infrastructure, you have to think about all these things that are needed and studies that are needed and so forth. So it's not just a 6-month, kind of 9-month kind of trend. This is a multi-year trend that's going on. And so in certain pockets, you could see a slowdown in the build out. In certain areas, that it may be quicker. But as everybody sees this happening, I think that's one of the components of what's happening with AI. And so that's where the energy needs come from as well, and some of the excitement around that. So it's not just the tech companies that are and the Mag 7 that are going to benefit. One, they're the ones spending all this money. So that's flowing through to other companies as well. And that's why I think it's part of the excitement around it from a market's perspective, meaning that, this is really propelling the economy. So at the margin, this spending has really supported the economy overall, just a different component that really wasn't expected at this scale 3 years ago.
Absolutely. Now, I know for years we've been talking about NVIDIA leading by so far. Are there other companies starting to catch up to them finally?
There are. So NVIDIA is kind of the most advanced chip maker,
sure, right.
and technically they're chip designer. So most of the times with the U.S. companies, they design the chip. So the semiconductor is really advanced kind of design to how do you get more power from the silicon wafer, how do you make it quicker and so forth. And so you have these advanced PhD level designs in the chip, and then you send it off to a fabrication firm. A lot of that happened in Taiwan. That was a big manufacturing base for semiconductors. And presently we're trying to build out more capacity, manufacturing capacity in the U.S., because as I mentioned, they're in everything, and that's how important strategically they are. So you'll see a more diversified manufacturing base. And so Intel was one of those companies that kind of had a resurgence, but this isn't an overnight, an overnight project. This takes years as well to get up to speed, to get employees up to speed, since it's extremely advanced manufacturing. So again, this is not a short-term little blip. This is a long-term. It will impact the economy in the not too distant future, if it isn't kind of already in play.
Yeah, it's affecting local economies and everywhere when it comes to price of your utility bills. Now, the whole Mag 7 versus the 493. Can you speak on that just for a second?
So one of the unique parts that to the market is that the Mag 7 stocks, the largest 7, have really become dominant in terms of the market cap, that's the size of the company, relative to the other 493 stocks, meaning it's these guys. You mentioned NVIDIA, you're talking about 4 to 5 trillion in size. That's massive. You go to common names like Disney or Starbucks, and, you're in this McDonald's, you're in this 100 to 300 billion range. And these are massive, well-known companies that have been around. but this is how much bigger these tech stocks would get. They're in the trillions in terms of their market cap size. They performed very well. The other 493 stocks in 2026 have actually started to perform better relative to the Mag 7. So you go in a phase where these popular names, the popular show on TV or media, and in 2025 they did really well. As you turn over into 26, though, well, there's some pause in these, and they've actually underperformed by a pretty good margin the other 493 stocks. So even though there's a lot of talk around those, they're not the only ones that make up a market, and there is other pockets of value to be had. So they're not the only winners. As I mentioned, they're doing the spending. You just flip the calendar, and all of a sudden you have the other opportunities to reveal themselves in the market and do relatively better.
Yeah, and you've seen that in earnings in the small and medium-sized companies. Is that what's been going on across the board?
Yeah. And we talked about this in first and second quarter. Earnings have been very good. It started with the large cap earnings, really driven by the Mag 7 stocks. And to give you an idea, the Mag 7 stocks make up of almost 40%. It's about 35% of the entire S&P 500 market cap, the size of the market. So that's how big. That's over the last 50 years. This is probably the highest level of market cap concentration, which to us tells us that, well, there's probably a lot of room for other stocks to start participating relative to the Mag 7. And that's just what history suggests, that you get to concentrated levels and it kind of deconcentrates in a relative sense. And why would it start to broaden out? Well, it's because earnings started to catch up. So where you have these large cap companies do really well over the last 3 years, all of a sudden with all the spending is trickled down into the mid cap stocks and the small cap stocks and small caps just recently, where earnings now have broken out of a kind of a consolidation phase where they're hitting new highs as well. And so there could definitely be a catch up phase as those earnings come through.
Yeah, I like the fact that you can almost see the money trickling down to other companies, other people. Spreading it out, and that's really helping diversification and portfolios to do very well with the diversification and making the money. It's pretty awesome.
Yeah, definitely. It's also a sign of a healthy market when you have broader participation versus just the concentrated. Before we were talking about, well, there's some risk with the concentration, but now that we've seen earnings kick in, that's just a sign of a healthier, more balanced market. And to your point, Brian, when you're building a diversified portfolio, and this is the reason you do build a diversified portfolio, is because the market is more than just a small subset of stocks, for example. That may be the darlings at the moment, but every year you'll have, these small subsets that kind of have these unique stories to them.
Absolutely. And that's all part about building portfolios for retirement. At Acres Financial Group, we'd love to sit down and talk with you about your retirement. All you got to do is give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. And we can sit down and talk about your individual situation to build portfolios that will help you reach your goals and win in retirement. Are your investments designed with your purpose in mind? We'll go over this when we return with more of Winning in Retirement.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Indeed, welcome back to Winning in Retirement. I'm Brian Akers, certified financial planner practitioner. I'm president and founder of Akers Financial Group. Our show today is called 2026 Mid-Year Market Review. If you like what you're hearing, or if you want to hear more of it, you can go to our website at AkersFinancialGroup.com. That's AKERS Financialgroup.com. Right there, hit the radio podcast. You can hear these shows through any podcast example that you can reach out to and listen. And Winning in Retirement is right there. Now we're back with our hosts, Brian Akers and Mark DiOrio. Mark DiOrio, you still there?
I am.
Yeah, I knew you were. I was just hoping you were. Got to keep you awake. In fourth quarter is a tough time because we really got to finish well and win the game, win the show,
Oh, for sure. It just as you mentioned in the World Cup, they provide extra time in case we don't finish.
And we don't get that on radio. I don't get to do plus 9 minutes and just see if somebody wins. And then the funny thing is when they go to extra time, they actually cut out. They cut out the 9 minutes. It's almost like it never existed.
Yeah.
All right. I don't. The World Cup can make you laugh with the way the acting of the players when they're injured. It's a very funny thing. But I do like the intensity. I love the skill sets. It's pretty fun to watch. All right. So also the fourth quarter is fun to watch, especially when Mark DiOrio's with me. I got tough questions this time. And what I said was for people out there listening, are your investments designed with your purpose in mind? I believe most people are buying investments. They are sold investments. They acquire an investment and they keep it for a long time. They're not really building out everything that they need to properly when it comes to why are they investing, what's the purpose behind it. I believe that Brookstone Management gives me lots of choices, which allows me to listen to the client and then to act on that in portfolio design. And I know, Mark, when you're building these portfolios, you have certain things in mind. Now, there's things called buffer portfolios that you've built, and I believe that helps buffer the downside for those that don't want all the downside of the market. Could you explain just a little bit about that for us?
Sure. And you bring up a good point, which is when you're building a portfolio, one of the words that we use, and we use this kind of acronym called RAISE, which stands for Risk Appropriate Investment Strategy Evaluation. The key word to me is appropriate, because you don't necessarily know what's the best investment until hindsight. Yep. And so it's really looking at, well, what's appropriate given your situation. So that's a really big philosophical underpinning where you're not selling something, as you mentioned, that investors like are sold something, or they here we're trying to use a research-driven approach, yep, determining what's appropriate. And to that end, we have a number of different investment strategies designed to do specific things. And some we would say, well, we like them all, but it's which would be appropriate in your situation. And so the buffered ETFs is a unique story. Mm-hmm. And the buffered ETFs, as you mentioned, what they're designed to do is buffer, as they mentioned, protect some of the downside. So you can invest in stocks and you get participation up to a certain level. So you kind of follow the market up to what they call a cap. So you get upside participation, but importantly, in this case, you get downside protection. Yeah. And so they list out different levels, varying levels of protection. Well, I want to protect the first 10% of the downside or the first 15% of the downside. You say, well, that makes a lot of sense. I can be comfortable being invested in stocks, knowing the history of the stock market and the declines. Well, that, really is a nice shock absorber and reduces some of the portfolio volatility while also allowing me to participate meaningfully in the market as well.
Yeah, so I like having these pieces because when you're talking to a client and they say, well, I've had all my money in the savings account, I have never invested before, then we got to start building it out for the long term. Adding some downside protection in liquid accounts and portfolios just makes sense in designing. Then you have some other people who are taking a lot of risk in their portfolios, and I got to bring the risk down. And I'd like to have some protection so that when if the market drops 10 or 15, I don't want us to get all the loss. Let's get only part of the loss, and that allows us to have more money to be able to grow back when the market does recover. The market, the last 3 years, we have not seen the normal 14, 15% reduction in the volatility market. It's been a pretty steady ride.
Yeah, and I mentioned the word resilience earlier in the call, and that's how I would define it, meaning we've had a couple with trades and tariffs, and then with Iranian conflict. I mean, it's been, the market reacts, but then all of a sudden it's as if it didn't happen from a market's perspective. Right. And so it kind of gets back on track. And so those have been any of the declines have been pretty short. And I think that has to do with what we talked about in the third quarter, which was the AI build out and the earnings growth. So really what's driving the market is not geopolitical events and crisis events, which do happen, which is part of the landscape, but that's not what drives long-term returns in the market, and it's that earnings growth. And then with this, in current times, what's driving it is the AI capital expenditures, which we don't seem to let up. But resilience is key, and I think your other point really got me thinking about when you're building that portfolio and how you want to calibrate the risk level based on the client, whether you have to take it down or bring it up. And really what we're trying to do is build enduring portfolios, and particularly, yes, in that retirement space, you want to make sure you have an enduring portfolio that can manage through different events that may occur.
Yeah, I love talking with my retirees where they get to a point where they, as an advisor, they say, "Hey, we're going to go win in retirement. We'll be back in a month or more. You handle it." And that's where I want people to be able to sit back, relax, and enjoy retirement years because they know things are getting taken care of. Now, the thing with me is that I'm being advisors for people and planners. We also can't be the full-time money manager and all. Now, so as we build portfolios, we have our AFG Select, which investment committee here at Acres Financial Group, and then you and myself, we get together on the portfolio allocations. I've been doing that for 9 years. We have 4 models, and we build that as part of our core. Then we add all the Brookstone ideas into the models to really build our active side. We do charge fees for that side. On the non-active side, we usually don't charge fees on that, depending on what the answer is. So we try to build out a portfolio of balance to provide the income they need when they need it, which is very nice. Now, Mark, I know when I'm designing portfolios and I have clients that are on the high tax brackets, you and I have been talking about tax efficiency a lot. And I love the fact that there's more and more options on tax efficiency investing. Do you mind just covering that topic a little bit here as we finish up the fourth quarter?
Sure. And there has been more emphasis, partly because of the rise in stocks over a number of years. But we're at that point, and some of the larger stocks we mentioned had a nice run. So some of the firms that we work with, we also, as we mentioned earlier, we review managers to see if they have value. They've augmented their tax-efficient investing suite, which gives us more tools. As we also talked about, Brian, you want more tools when you're implementing a portfolio. So this is relatively new last few years, and it's just grown. In 2026, we've seen a bigger demand for tax-efficient investing strategies. One of those ideas is called direct indexing. So if you hear that term, direct indexing is usually a term used for, well, do I want a little more tax-efficient portfolio? This is one of the ways to do that. And this is where you can build an individual stock portfolio, kind of maintain the performance consistent with the market, but along the way, you're realizing losses in any of those stocks that may be underperforming, as opposed to just having a full index fund and you just continue to hold those stocks. This is just one of the ideas wrapped in there. There's also strategies that allow you to, if you have highly appreciated stock and you say, well, I don't want to sell it and realize all the gains, but I would like to maybe diversify that and maybe slowly exit the stock, or not, or just diversify it. They actually have a few strategies where you can bring on a highly appreciated stock, and then they'll build a diversified portfolio around that with a couple of key inputs where they take on additional stocks. And so there's really unique approaches that if investors haven't taken a look at them, and it's one of those concerns, I would suggest they take a peek at this, because I think you'd have a nice kind of conversation around what's available to them now.
Yeah, I know with certain clients and with inheritance and multi-generation legacy planning, we have to do tax-efficient portfolios so that we don't blow up their tax returns on that at a trust level, because the tax rate's so high. The thing about any type of design that we do at Acres Financial Group, we start with the client, their unique financial fingerprint, where they are, and then we build from there. Building that and bringing in experts like Mark DiOrio and their group to help us manage and to have the tools we need to provide what that client needs for now and for their future is the key of the whole package that we're trying to work with these clients with. Now, at Acres Financial Group, we're blessed with many advisors helping us, with teams of advisors helping the clients. And then we're blessed with Mark DiOrio and all your investment staff out of Wheaton, Illinois. It's been a good time. I'm talking with you today, Mark, about the markets. I just want a final question is the last 6 months of the year, where are we heading? Are we heading straight up, a little sideways, a little pause? What do you think is going to happen on the last bit here?
Yeah, I think maybe a little pause into the midterm, but
Sure.
Overall, I don't think that shakes out the overall trend. Could see higher prices at year end.
Okay, so you're very positive to the market. I appreciate that very much, Mark. Thank you very much for being on the show today. Mark DiOrio is a Chief Investment Officer from Brookstone Capital Management. They're a third-party money manager that we use from Acres Financial Group. When you have portfolios with us, so what happens is the part of the fee goes to the managers, part of the fee goes to the advisors, and that's how we work as an investment advisor representatives with portfolio management. All right. So today we covered the mid-year market review. We thank you for doing that. We look forward to meeting with you. We want you to win in retirement by taking advantage of this opportunity to begin planning with us at Acres Financial Group. To schedule a free meeting with one of our team of advisors, go to our website at acresfinancialgroup.com. Scroll to the schedule a meeting section and let us know you'd like to schedule your free meeting right there. That's acresfinancialgroup.com, or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person meeting with one of our team of advisors. Start planning for your retirement now. Go to acresfinancialgroup.com or call us at 833-946-7384. Thank you for listening. I'm Brian Akers from Acres Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Acres Financial Group. Acres Financial Group offers securities through Archedios Capital, an SIPC and FINRA member firm. Advisory services are provided through Archedios Wealth. Acres Financial Group and Archedios do not share any common ownership. Neither Archedios nor Acres Financial Group provides tax or legal advice. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.